Good afternoon, everybody. This is Jim Kenny, and this is the OptionProfessor.com weekly update on the markets. And we are going to go over many things here today because next week is going to be a very exciting week on news. So I'm going to go over that as well. But before we get started, as always, I do remind everybody that past performance is not necessarily indicative of future results, and that short-term trading, option trading, and that type of activity does require substantial risk of loss, and it's not right for everybody. So again, consult with your clearing firm, your broker, your advisor to good common sense before you consider any investment. Okay, now background on myself. I'm Jim Kinney, graduate Boston College, been in the investment arena here for decades. Have done many things, including seminars educating people on the uses and risks of options, and basically options that can be used for limited risk speculation, as well as the use for cash flow, covered writing, etc., and also used for hedging, where you try to protect either a downside move, reducing the value of your portfolio, or you use it to hedge an up move because you're out, and you certainly don't want to be rebuying at extremely high levels if you sell out. So lots to learn. If you have any questions at all, I recommend very strongly that you just send me an email at OptionProfessor, OptionProfessor @gmail.com, and I'll try to give you a hand with any question you might have. Okay. All right. So having said that, let's take a look at what's we got. The closing prices today are all in. So let's take a look at where they took it home. Looks like the Dow went home at 27,154. That's down 68 points. Obviously, it was up well above 27,300 and almost 27,350. And then it went into the toilet at the end of the day. Here we go with the NASDAQ above 82, about 82.40 early in the day, and then it went home well down at 81.46. So yeah, a little bit of a sell-off going into the end of the day. There was a report of the some ships with Iranian forces taking them over or something like that. It caused some stir today. Not much really on the oil market because there is a ton of oil out there and we do not depend on foreign oil anymore. So these skirmishes in the Gulf are a lot less risky than they were back in the 70s, 80s, and 90s when it would have possibly shot the market up dramatically. And so basically that was one thing that came out. Next week, we've got a lot of stuff coming out. We've got earnings from who? Google, Amazon. You've got them from Facebook. You got them from Intel. You got them from Tesla and many others. So next week is going to be huge. And then next week on Thursday, the ECB is going to come out and tell you what they're doing with interest rates or their monetary policy, which is probably going to be more printing money and then buying their own stuff, which is a thing that started in Japan and has obviously spread throughout the world. Apparently, you print money, you buy your own stuff, it keeps the price up. And then, of course, interest rates go negative. And then the banks go into big trouble because if you look at the European banks, they're all very discounted for a reason. And then, of course, their growth stinks, and that's all the great print money, buy your own stuff. That's all that's done for them. Here in the U.S., obviously, we printed $4.2 trillion to buy bad loans from banks that made bad loans and other stuff like that, and that has caused our interest rates to be much lower than normal, particularly with 3.7% unemployment, particularly with the S&P where it's trading, and the Dow and the Nasdaq, and particularly with housing prices where they are and everything else. So you can clamor that the world's coming to an end and the economy is weak and everything is going bad, but that's not really what the numbers are saying. Retail sales and everything else. So we'll have to see if they clean up some of the manure that's coming out there and maybe moderate some of the opinions. Because in December we were supposed to have 4 hikes this year. And then after he pivoted, we're supposed to get 4 cuts this year. And people are looking for 50-point cuts, and others are looking for others. So bottom line, it's getting pretty wild in the prediction business out there. One guy from JP Morgan is saying interest rates are going to go down to 0. And so, you've got it all over the place. If you like variety, you're certainly getting a big variety of people and their opinions. All right, let me show you some of the stuff that I'm looking at and see how, and I'll give you my opinion, my view on what I'm seeing. Let's take a look at that S&P. Okay, I'll give you a background on my view on the S&P, and I'll bring it up to you now. So my view on the S&P S&P as we went into the toilet in December down to 2350. And at that point, if you recall, regular listeners would recall that the 200-day moving average was up around 2750, and I thought there was a better than even chance going back to the mean, which is what it did. So now we're in the 2700, 2800 level, and it's not breaking, and we break above 2800. That set the stage for testing the highs at 2950, which we did. After we tested the high, bam, they brought it down to 2722, and now they brought it back up to the high, and now they've made new highs up to 3017. Today we took it home at 2976, and we started the day up, or earlier in the day we were at 3006. So it definitely got hit a little bit, and it broke some short-term support at 2980 area. I'm going to show you a short-term chart so you get the idea where that's coming from. Let's look at the 10-day. And on the 10-day, you will notice when I get this thing up and at 'em here that this 2990 area, 2980 that I was talking about, there was support there because it came down and bounced back up. So that makes it support. Once it breaks that number, that's your first time break. Where would the more significant break come from? In my view, a break of 2950. Let's take a look at the moving averages and see if, in fact, they're telling us anything. We've got the 50-day moving average at 2,900. So we're we're 76 points above that. But look how far we are above the 200-day, 2782. So we are about 200 points above it. And at one point at 3017, we were way over 200 points above it, closer to almost 250. So that's what I would call extended. And sometimes when things are extended, they come back down. When they're extended, that is when you'd enjoy, you would, shall we say, entertain the idea of hedging. Why would you? Because if the market's going to have a correction, and obviously you have big gains, you'd like to protect those gains. So how do you protect those gains? A lot of ways, right? You can sell off some positions, keep some. You could use options. What type of strategies are used for hedging? Covered call writing. That's where you sell an out of the money call, and you collect a premium. That premium minus where you did it is giving you a downside hedge to the limit of that premium. Now, it also limits your upside, so there's that too. Now, how about we talk about collars? There, you're going to combine an out-of-the-money call. You're going to grab that premium, and underneath, you're going to buy a put. Now you've bracketed your equity. You got upside potential to the strike, and you've got downside support, or shall we say hedge, at the put price, because one paid for another in the example I just mentioned. The strike prices are your upside and your downside. Finally, you could do a married put. If you made $50 or $60 on the stock, why not take a little bit out and buy a put, so that if the market goes in the tank, you've got insurance at the strike price less the premium. Now, the other thing you can do is you can sell out stock and replace it with long-term calls. Therefore, if you replace a stock that's going for $180 with a $5 call and the stock drops $60, then you don't lose the $60, you only lose the $5 call. So the bottom line is there's a lot of different ways to hedge. I'm certainly familiar with many of them after being in this decades. And that's why I encourage you, if you have questions and like to go over the fine print as far as what the actual numbers are, what the actual risk is, what's the upside potential, and all the other questions you might have, shoot me an email. OptionProfessor@gmail.com. It's kind of silly not to. You're listening to the broadcast. You have people you know who could be listening to the broadcast. You can let them know how to come next week, but also you can also let them know that there is somebody who could explain hedging to them while the sun is out and while the sun is beating brightly. Again, the market still looks in good condition technically. 2,900 on the 50-day. 200-day at 27 and change. They're inverted to the upside. Nothing wrong with that. The only thing here is that, we've come a long way, and the valuation of the stock market is certainly quite high, and the dividend yield on the stock market has dropped substantially, and the valuations plus the lower yielding situation, sometimes is a recipe for a pullback. And again, the enthusiasm that the Fed's got your back, and the enthusiasm that the Fed's going to just be cutting, 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 and that everything's going to go up like a rocket ship, which is what Mr. Trump seems to be looking to do. All of that stuff could be, kind of at the end, the entering period of a cycle. Now, again, getting back, let's go back to the chart so I can tell you what I'm looking at now as far as, when we were down there in the 2,800 mark, I came up with a zone that I thought was a zone for selling. And that zone was 2950 on the bottom and 3100 on the up. And I still remain saying that that looks like a sell zone, meaning that's where you'd take some profits. That's a zone where you'd hedge. That's a zone where you'd lighten your liability between 2950 and 3100. And it is having some trouble at the lower 3000 area, but that still could get taken out and they could go a little bit higher. But I think getting above 3100 is a tough racket. And I think once we break under 2950, if we break under 2950, it'll add more credence that the short-term highs are in. That's my view. That's how I'm seeing it. And let's take a look at some other things that I'm looking at here. How about the Dow Jones Transportation Average? That has been a dog, but it has been a dog now that's been barking a little bit. Today it's at 10,604. It lost about 70 points at the end of the day. So obviously it's had a bounce back up. But it certainly is what? It is certainly having some trouble. Now, I will give it this. The 200-day and the 50-day are under the market, and they probably are rising because they're in the 10.3 area. So bottom line is we came down, but we're holding those moving average, and that's constructive. The fact that we are, the high on this index is 11,623, and we're 1,000 points underneath it is not so constructive. And getting back under 10.6 and then getting back under 10,000, I think would be very problematic. So if this thing stays firm, God bless it, it's starting to turn. And it could take out the 11.6 over time. If this S&P is going to 3,500 or 3,600, it probably will take it out. But if that's not going to happen and we're going to have a correction, this thing has been telling you that it can't make a higher high, that it can hardly make a higher high, and it still can't make a higher high. That's what it's been telling you. Okay, so we'll have to see. Again, you got to not fight the tape, and you got to not fight the Fed. But the Fed has just basically stalled since December. They haven't gone through any big cutting. Next week, again, Thursday, you've got Draghi, and Friday, you've got second quarter GDP. Second quarter GDP comes out robust. It's not going to make the Fed want to cut more because using your ammunition when it's sunny out, using all your raincoats and wearing them out when it's sunny out is stupid. And I don't think Mr. Powell and his buddies are stupid. So again, they're not going to try to get interest rates down to zero and the S&P up to 4,500 just because somebody wants to get elected. Because after they get elected or don't get elected, they're going to be stuck with the mess. And if they have no ammo, the next time this thing really rolls over, they're not going to be very happy that they used all their ammo, while things were good. That's my take on it. The other thing about the China deal, China is a very patient country, right? They think in terms of centuries, not months. And disrespecting them during negotiation, is probably not the tactic that works best. So who knows what's going on the other side of the coin. If they strike a deal, my feeling is that it'll be a watered down deal and it'll be just like the handshakes and all these things. It'll be a photo op. And I think they're waiting and waiting and waiting. So it'll be a photo op and nothing more. Or there'll be something going on, something to level the field, but not as dramatic as people are talking. Okay, now Russell Index, another one that has been telling me that this is a rally that will not last. Why? Because we're at 1750 on the all-time high, way back here area, and then we come way down, we come back up, no new high, come back down, go back up, no new high, and now we've come back up, and again, is no new high. So if this thing breaks under 1500 and the Dow transports get back under 10, then I would think that a significant correction and the VIX, which I'll show you in a minute, gets above a certain level, I would get prepared for a drop. And again, right now, things are okay. The moving averages on this is underneath the market, just like the transport. So the surprise could very well be to the upside, but it is on a ledge. Get above 1600, I think you're back in the game. Get under 1500, and I think in the short run, you're going to have some problems. So, you're stuck in the middle here, and, whichever way it wants to break. With regards to the VIX, another thing I keep an eye on that I suggest you do the same. All right. Now, what do you got here? VIX is at 1445, up almost 7% today. Closed right on the high. Let's take a look here and see what's going on. It recently went down into 12. Can you see that's a double low? And can you see 15 is an important point? So if you start breaking above 15 and 17, it's going to open the door to shooting to 20, which means the odds of a correction is going to go up very dramatically if we can get this VIX above 15 and 17. That's how I see it, and that's what I would suggest you keep an eye on. The VIX is on the verge, if it can get above 15 or 17, to start going towards 20. And if we go towards 20, it's going to be accompanied, in my view, by a correction. If you're not prepared for that, you might want to at least look around to see, as an alternative, what are you going to do if that happens? Okay, now what are we looking at here? Let's look at some of the stocks that are going to be announcing. We have got Google, Alphabet going to be announcing. Let's take a quick look at some of these real quick, and then I'm going to get into some other sectors and a few other things before we shut it down. Okay, Google. Down 16 today, and so that's a pretty good size hit, down 1.5%. Was as high as 151, so it lost $21 today. Let's see what it looks like on the chart. Yeah, see, it got up here to 1150, right? 1160 and whatever, right in there, and then it's starting to turn down. There's a little bit of a gap down here. Maybe it'll come down and get it. But if earnings get going, this is the gap there that you would think it's trying to fill, right? So if we start breaking out above this week's highs, then I would say that the train, and it does it on the earnings, then I'd say that the train probably wants to get into this gap of 1200 and 1250. That's how I would see it. Right now, it looks like it's on the defensive a little bit. Take a look at the moving averages real quick. Let's see what I can find for you here. The moving averages. Oh, I wanted the moving averages. I didn't want that. Hold on. Get the detailed quote up here, and let's get it cooking. Here we go. All right. Now you're going to be looking at the moving averages. They're at 1115 and 1116. So they're underneath the market. So the market is still okay technically from there. But the volume was a little bit higher than normal here lately, and it was a selling volume. So be careful of it here. Like I say, I think the numbers will speak for themselves. This thing starts breaking back underneath 1100 and these moving averages. I think that would be a negative. So 1115, 1116 would be a line in the sand I'd be looking at. And conversely, start breaking above this week's high, and it opens the door to fill in that gap that I showed you. Keep an eye on it. It's probably going to be moving next week. All right, what are we looking at here as Amazon? Amazon tried to make a new all-time high, and it failed. Now let's see what it did today. Yep, it's still back down. So 2050 was the high, and take a look here. 2050 was the high, and you couldn't take it out. Now it's down here. Now, if it starts taking that out, you're into new highs, and Lord knows where it's going to go from there. But you see the volume's drying up a little bit here. So if this thing has earnings or reports that people don't like, and you see this volume jump up like it did there, like it did there, like it did there, like it did here, you're going to see a big drop on this stock because, again, the volume is dried up, which means what? People are waiting. And if the news is not very good, all these people that are in are going to want to start coming out. And who's going to buy way up here if the news isn't good? So you got to be careful about Amazon, especially around the earnings. Okay, now the other one coming out is Facebook. Facebook, a lot of people think it's going to go up and take out that 223 area. And a lot of people think you buy this stock here before it goes. And again, you can't see it here, but there's a gap up there, 223 down here. It filled in quite a bit of it here. So if we can get above this 205, 206 area that's been resistance this week, then it opens the door to hit 220 on the earnings that's coming out. You have to watch it. And again, breaking under 190 obviously might confirm that in the short basis, this thing's hit a high point. All right. And Intel. Let's take a look at Intel real quick. Again, these are my views, my opinions, my observations. Obviously, everybody's got some different ones. And let's take a look here at Intel, INTC. Okay, on Intel, you're at a little bit today and then down a little bit in the aftermarket. And again, this is a company that used to be at 60, dropped all the way down here to 40 and something. And then on lighter volume, it's been having a rally. Is it going to try to get into that gap between 58 and 52 ballpark figure? It will if next week they have good news and they take out this week's highs. Could very well do that. Conversely, I think somewhere in this 48 area, it had better hold on any pullback. And so it does look like it wants to take off, with some of the other tech stocks. So if it gets good news and this volume starts popping up, like it did here and here during the big drop, that would be very positive. So getting a nice volume spike here would be nice. You got a big volume spike here, but again, that was during a drop. So during the drops, obviously the volume can really spike up. So if this thing starts rolling over past 49 area, today's low is 49.91, starts taking out 49 and the volume starts popping, there could be more to follow to the downside. But right now it looks pretty good. It looks like it's going through a rebound rally. Okay. A couple of things I wanted to go over. The oil companies. A lot of people were thinking the oils might get going here, but they've had a hard time. Royal Dutch is one that I look at because it pays 5%. P ratio is 11, not too shabby, and it had a correction down. You've got some stuff going on in. And you got a tail there. So I would say 62 is a good floor on the thing, and it could possibly give you some more upside, and you're getting 5% to watch the movie. Starts taking out 62, that would be trouble for Royal Dutch in my view. Another one that pays nice dividend is British Petroleum. And British Petroleum is a company that pays 6.22 as a dividend, according to my screen, and that's 13 PE ratio, and again, this one got hit a little bit after it ran up towards 46, and now it's hanging on a little bit for dear life. And so it's got a tail there. So I would say 38 is as far as I would give it. And if it can start closing that gap and moving up, that would be great. And that is paying a dividend. Another one that is paying a dividend is Philip Morris. And Philip Morris pays a healthy dividend of over 5%. It's at 88 and change. This is one of your sin stocks because they've got a little bit of everything going, and people have been applying into this. Don't forget, when you're getting a nice dividend, you can hold on and get a nice dividend while you watch the movie. If the movie's going from 75 to 90 or 88, it's a good movie. Again, it can also fall very dramatically like it did here, but that was when all stocks dropped in December. After that drop, people have jumped into this. Big pullback bet down to 75, but now it's back on the bicycle. Again, that's one that I keep an eye on because of the dividend. And then here we go with telephone. Another one that pays a good dividend, and it pays 6.22 and 32.79, and that has been trying to turn up as well. Telecommunications have been doing pretty good. So you're getting paid 6 and change while you're watching the market go from 27 to 29 to 30 to 32, and now it's a little bit above 32. So it's not a bad place to have parked money here in the last 6 months. Okay, now I don't have a tremendous amount of time left, so I'm going to give you another area that people are looking at right now, and that is Boeing. My feeling on Boeing is 340 and 350 looks like the low. And so, obviously it's up 16 today. It pays 2.18. That's not tremendous, but it's not terrible. It's not zero, right? And Boeing, again, seems like a lot of their bad news is getting behind them. If that's in fact true, you're probably not going to take out 340. And if you do take out 380, it's possible you could be as much as 50 or $100 higher in the future because this company only has one competitor to speak of. And if they start getting their planes going again and they start getting that mojo going again, then I think obviously 446 is not off the table in the years to come. So again, Boeing is been back on the rebound here as they're trying to resolve some of their very terrible issues off of those tragedies. Okay, now let's go over to gold, and we will go to the mining shares. And I am going to rattle off some symbols that I'm watching because I want to share with you, and you can look at them yourself. But the gold had a big run. Okay, so it may have a pullback. You know, the moving averages on gold itself is in the 14. Excuse me, well, let's go look at it real quick so you know. See, when markets get way above their moving averages, I get nervous. Why do I get nervous? Because I consider that extended. When they're extended, what can happen? It can have a pullback. So we went to 1454. Gold's only down $1, but the mining shares are down more. I don't know if they're leading or not, but just want to get this up here now and see if I can show you the moving averages, if the screen will stop bouncing on me. And the moving averages on gold are 1,300 and 1,250. We're up at 1,450. So not unlike the S&P, these things are pretty far away from their moving averages, and a correction is not off the table. So on a correction, there could be many stocks to look at in the gold area, and I'm going to rattle off some of them. One is FNV, that's your Franco, and then RGLDs, your Royal Gold. Then you got the juniors, GLDJ. Then you got KL, which has done very well, AU, and then under $10, there's a couple here. Well, there's one here, ATSUF. Some of these are gold miners. Some of them have to do with leasing. So look into it further, get more educated, see what it's all about, and see what you like. Under $5, you've got AU colon EVN, which is under $5. You've also got a symbol of KGC, SPOXF, and then you've got CA colon SRHI and CA colon SII. So those are some of the gold shares that I'm looking at and monitoring. And if you'd like to monitor them as well and see if you can make your own decision on what you think the merits are, you know, that might not be a terrible place. Last thing I'm looking at here is the silver prices. And let's take a look at what they're doing. So SLV. Well, let's see if I can just get the future up here. That would be nice. Continuous contract, nice. And we'll get that going. Okay, it's at 1623. It's up very close to the 52-week high. It's starting to play catch up on gold. And the gold to silver ratio is like 80 or 90, which historically is just off the charts. And let's just see now what silver looks like, and then we'll shut it down right after that. Okay, hold on here. There you go. Well, I'll tell you what, rather than fight the machine here, I'm just going to rattle off some silvers that I'm looking at. PAAS, Wheaton, WPM, under $10, SILJ, which is an ETF. And then you've got AG, under $5, EXK, HL, CDE, FSM, SVM, USAS. So there you got some different stocks that I'm monitoring. And if you'd like them to go on your radar and monitor them yourself, please feel free to do so. A couple of last things I forgot to do. One is the 10-year note. Let's take a look at what that looks like, because again, you know, if this GDP number is very strong next Friday, then these things, the yields could pop to 225, even 250, if the GDP number is very strong. If not, and we're really seeing a rollover, then obviously taking out 2% on the 10-year is certainly possible. So we're going to get some volatility, I think, next week because of the economic numbers and the earnings and everything else. Last but not least, I'm keeping an eye on soybeans. This is a closeout thing that I'm doing right now. And let me get the continuous contract up there and give you an idea, because I'm monitoring this. Of course, there's supposed to be big orders coming out of China, right? So I've been talking to people about this. It seems to me that if we can get above 950, that you've got a pretty good shot at a run-up, and the run-up could be, you know, pretty good, because this thing has been in the tank for a while. You see, if we can get above this 940 area, look at this move today, up 20. So it's starting to get on its bicycle. Volume's not tremendous. I'd like to see a big volume breakout. That'd be lovely. But again, this sellout to 8 looks like the low, and the moving averages are turning up. and a break above 940, 950 could give us a very substantial move, because this 940 area has been trouble for the last year. Keep an eye on that. I'm keeping an eye on it. And then, like I say, if you have questions on any of the stuff I mentioned or anything that you have that I didn't mention, just shoot me an email, optionprofessor@gmail.com. OPTION, professor @gmail.com. And of course, next Friday I'll be back here. So tell your friends and neighbors that they can go to optionprofessor.com and get the link so they can tune into this and ask me questions if they have them, and also keep abreast on my views, my opinions, and my thoughts. Okay, guys, it's the weekend. Let's go have some fun, and I'll be back with you next week. Until then, good luck and good trading. Bye now.